Hi friends, I am Kevin Shaji and I am now starting a new video series on CA Intermediate Financial Management course. Why I am doing this? This will help me to get more knowledge. Also, I'll be able to share my knowledge. That is the simple reason why I am making this video. So, the first chapter in intermediate financial management is scope and objective of financial management. In the first page, they mention what we learn from this. I will cover this after completing the chapter. So, I will be going based upon the institute provided study material, and I will also solve the problems that have been provided from the institute provided study material only. So that is what I want to tell. So let's start. So financial management. What is financial management? To understand what financial management is, we need to understand how the business journey goes on. If I want to start a business, I need some assets. Suppose I am starting a trading enterprise. I need a shop. I need a retail shop. I'm doing a retail shop, retail trading business. Suppose, simple. I need to start a stationery business. I need to have a stationery shop. I need to buy raw materials. I need to, maybe I am the only employee. I will be selling goods directly. So, an employee may not be required. Sometimes an employee will be required. So, this is a simple business model of a retail store or retail stationery store. If I want to start a manufacturing entity, I need to set up a manufacturing factory. I need to install machineries. So this is the basic structure of a manufacturing entity. So for this, we need to decide what all assets to purchase. Then we need to understand what the total investments are required in purchasing those assets. Then for daily running, I need to buy raw materials. I need to have some employees to run the business. And I need to basic other expenses required for daily operations. This requires working capital expenses, working capital requirements like raw materials, salary, wages, and all. For this funding, what is the source of funds? If I am starting the business, I may bring from my own sources as capital. I may take bank borrowing. So this we call as source of funding, from where we bring the money. So this is a basic understanding of financial management. From where to deploy the money, where to bring the money, where to bring the money, where to deploy the money. And once the fund is deployed, that will give us some return. That will give us some profit. This profit, how to distribute among the persons who bought the money. This is a simple understanding of financial management. As I told you earlier, I'll be going based upon the institute study material. And I feel compared to the material which I have gone through, the current institute material is very simple. That's another reason why I go based upon institute material. So to so now I'll continue. So promoter or the businessman he will decide from where the money to bring, from where the money should be bought in. That is by raising capital or by bank borrowing, is based upon the cost that is incurred. If I am bringing my fund in the business, I expect the full profit to be taken from my side. If I want to bring my friends or family members into the business, and if I want their capital to be bought in, they also demand the same thing. If I want to bring banks money, bank may not demand share of profit, but they may demand a fixed rate. We call as interest. So financial management is uh, this a discipline that is concerned with efficient acquisition of finance and efficient allocation of finance and efficient distribution. So simply it is where the money should bring, that is from equity or from debentures or from banks, like that. and where to invest those funds, and to how to satisfy the investors. Investors are can be myself. I am investing money, my capital, or other capital provider, or banks. So how to satisfy them? To satisfy banks, simple. You have to give him principal back. You have to give him interest. To equity providers, you have to satisfy them by giving more cash flow to them. So this is a simple understanding of financial management. There are multiple definitions of financial management. I will go with a very simple definition of financial management. Financial management is concerned with managing decisions that result in acquisition and financing of short-term and long-term credit for the firm. So it is like how from where they will acquire the fund and where managing the short-term and long-term credits. Can be banking. So just to be simple manner, financial management is to understand and deal with procurement of fund and utilization of fund. You have to procure the money and how to utilize it. You're utilizing the fund with expectation of returns and how this return to be distributed. This is simple financial management. Procurement of funds. From where you will bring the money. You will bring the money from owner. If I am starting the business, I will bring from my own sources. I will may have to borrow the money. It can be through commercial banks, or through debentures. It can be through venture capital, through angel financing, etc. It can be multiple sources, which we will cover in later part of the chapter. There are multiple sources. Even now, new angel finance is a new system where high net worth people will invest in the business. Similarly, there is new concept called carbon credits, where based upon the pollution that you create or the renewable energy that you generate, there is a system called carbon credits. That is also a new form of financing. We'll cover one by one item now. Equity. Equity is nothing but the money that is borne by the promoters. Equity by the owners of the fund. Owners expect the profit, share of profit. So that is the most expensive source of fund because they expect the highest. If the entity makes huge profit, they also expect the share from that. So a person who brings equity, they expect highest return possible. That's the reason the equity cost of equity is highest compared to all other source of equity, all other source of funds. Sorry. Then debentures, comparatively cheaper more because of one, it is having tax advantage. I will give simple reason. An entity makes profit. This profit this profit name we can reduce the tax interest amount. So this interest is a tax deductible expenses. So whatever that is received back after reducing interest, that is available to equity holders. So amount that is paid to equity holder is fully taxed. Debenture holder is, but debenture, when you're bringing money in the form of borrowing or debentures, amount that is payable to them is at least interest portion is tax deducted. So that is an advantage of debentures and bank borrowings. Also, debenture holder, we have a fixed amount to be paid. So that, what do you call, suppose we tell that we need to pay only 12%, and an entity and business makes 18%. So the promoters will get benefited because the debenture holder need to be paid only 12%. The balance will be available to the equity holder. This how this is beneficial we'll cover later. This benefit we call as leverage benefit that we'll cover later. So debenture holder is beneficial because it is having tax advantage. Also, it is a fixed expense. So if entity makes huge profit, they need not pay the entire profit to debenture holders. But there's a downside in this. Suppose entity doesn't make any profit. even then they need to pay to debenture holders, even though they don't want to pay to equity holders. Because debenture holders, we have to pay fixed amount to debenture holders. So even if entity doesn't make anything, they are forced to pay money to the debenture holders. So that is a major difference between equity holders and debenture holders. So that's it. As of now, I will balance things I'll cover in later slides, later videos. I hope you like the video and I hope this will be helpful for your upcoming examination. Thank you all.